The RBA hiked as expected yesterday, but not quite as hawkishly as some players in the market expected. So the Aussie dollar fell. That's coming up in our 5 things in 5 minutes. And then in our bonus deep dive interview, ANZ senior commodity strategist Daniel Hynes has noticed a big change in central bank buying of gold for their reserves.
The heightened sort of geopolitical risks that we're seeing now in the market, are really pushing, particularly for developing countries, to really diversify that reserve base, and gold's, being the perfect asset for that.
But first, in 5 and 5 with ANZ, as widely expected, the Reserve Bank of Australia hiked its cash rate by 25 basis points to 4.35% yesterday, ending a 4-month pause. The new RBA Governor, Michelle Bullock, said in his statement with the decision that whether more tightening was required would depend on the data on whether inflation kept trending down. ANZ's senior economist for Australia, Adelaide Timbrell, thinks the one hike is most likely for now, but the risks are skewed towards another hike.
We haven't seen enough data to add a further rate hike to our forecast, but the risks of a further rate hike seem to have increased. The November statement highlighted the increased risk of inflation remaining high for longer, and also said that the inflation rate is expected to be around 3.5% by the end of 2024 and the top of the target range by the end of 2025. Now, given that the underlying assumption of the cash rate in the new forecasts are higher than the last because they come from market pricing, this is a higher inflation forecast than what we saw in the August outlook, and shows a bit of pessimism about the inflation outlook from the Reserve Bank.
Number 2. Financial markets, however, saw the governor's statement as relatively dovish, meaning her comments about future rate hikes weren't seen as tough as previous ones. That pushed both the Aussie dollar and the Kiwi dollar lower, although part of the reason for that was US dollar weakness because bond yields fell overnight in the United States. Bullock said last month some further tightening may be required, but this month she said whether further tightening was required, which markets viewed as slightly dovish on the nuances. Elsewhere overnight, the US 10-year yield fell 7 basis points to 4.59%. Oil prices fell nearly 4%, with Brent crude down at $82.70 US a barrel. That was after some weak Chinese trade figures. And US stocks are broadly unchanged around 5 o'clock Australian time. Number 3, there was mixed news overnight from Chinese trade figures. Exports were weaker than expected, but imports were stronger. Here's Betty Wang, ANZ Asia economist.
I think from the higher than expected imports data, it might suggest that the economy has bottomed out and the domestic demand have started to pick up gradually, especially thanks to the supportive measures. And on the export side, we do think that, with semiconductor cycle bottoming out and holiday seasons approaching, we might see China's export outlook to improve towards the end of this year.
Number 4, one area of China's economy that ANZ senior commodity strategist Daniel Hynes is watching closely is steel company profits, and they're falling fast.
That's going to be a pretty heavy weight on steel prices for the foreseeable future. And as a consequence, margins are getting really hit because iron ore prices, their major raw material input, is actually rising. We've seen because of some supply side issues, iron ore market remain relatively tight, and that's kept prices high. But their selling price, the steel, is falling. So it's hard to really see how that can really turn around in the shorter term. And I think ultimately, it's going to force steel producers to cut back on output, which I think the market needs.
Number 5, Philippines inflation data out yesterday was weaker than expected. But ANZ's chief economist for Southeast Asia and India, Sanjay Mathur, said the central bank in the Philippines will still be keeping a hawkish eye on inflation pressures and inflation expectations in particular.
The main difference really was around food prices, which had been rising quite rapidly over the last few months. And it appears that the autumn harvest seems to have depressed prices for now, And I say for now because we think longer term prices will rise again.
And how do you think the Philippines Central Bank will assess this news?
Well, certainly this is good news for the central bank because the central bank just a couple of weeks ago had raised interest rates in an off cycle manner. And this time around, I think they do have some room to pause. But to give up their hawkish stance, it is very early for them to do so.
Sanjay Mathu there. Now, in our bonus deep dive interview, we look at the strength in gold prices recently. That's despite a substantial shift higher in US Treasury yields. Typically, they move in opposite directions because gold doesn't produce a yield and US government bonds do, and they're both seen as types of safe havens. So, what's changed? ANZ's senior commodity strategist Daniel Hynes has put out a research note showing a near doubling in gold purchases by central banks in the last couple of years. It wasn't always like that. Here's Daniel.
Yeah, look, we had a period there where there was, a lot of central bank selling in a sense. Back, a couple of decades ago, it was really, they didn't sort of see, I suppose, gold as being an important part of their reserves. And so there was a strong period of selling contained by a central bank agreement where they were only allowed to sell a certain tonnage per year. But, that does seem to have turned around quite sharply. And I think, they now realise the benefits of having quite a diverse sort of range of currencies, not just, based around US dollars. So pushing into other major currencies, but also gold. And I think the heightened sort of geopolitical risks that we're seeing now in the market, are really pushing, particularly for developing countries, to really diversify that reserve base, and gold's, being the perfect asset for that. And, I think even after a pretty strong couple of years, it's hard to see that really easing up anytime soon. I mean, China in itself has made it pretty clear it wants to, increase its allocation to this asset class. So I expect to see pretty strong flows in the near term.
When the war in Ukraine started, we saw US dollar payments and US dollar assets targeted in sanctions, and that seems to have shifted the broad view about the need to diversify away a bit from the US dollar for some countries.
Yeah, absolutely. And you can see that across the broader sort of commodity complex. I mean, there's been moves periodically over the years, to price oil, for example, in other currencies. I mean, the Chinese in particular have, set up some contracts in CNY. The Saudi Arabians have looked to do it in other currencies as well. So, it's a move which has been tried before, but I expect, obviously, with the US dollar seemingly being more weaponized these days amidst these geopolitical risks, that it's something which is very in front of mind, I suppose, for non-US dollar denominated producers and consumers, really. And so it's a much broader issue than obviously just diversifying their reserve base. It's more about securing the commodities they need without being, I suppose, exposed to a lot of these risks.
ANZ's Daniel Hynes there. I'm Bernard Hickey. That was 5 and 5 with ANZ for Wednesday, November the 8th. Catch you tomorrow with a deep dive interview with Brian Martin into why Europe's economy could be going into a recession. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.